Next, we turn to an exercise where a company has issued a 5-year, 5% coupon bond with a $10,000 face value, but this time it's at an original issue premium, not an original issue discount. Same assumptions as in the prior exercises in terms of the maturity date of the loan, January 1st, 2020. Assume a 40% tax rate, assume cash revenues and cash expenses as illustrated, and now the same question, how do we account for this on the balance sheet and the income statement? So give that a shot yourself, hit pause, try it, and when you're ready, hit unpause and we'll go through it together as a group. Okay, so let's go through this exercise. Just like before, the first challenge is to identify what is the implied interest expense. So we lay out the inflows and outflows associated with an original issue premium bond. On day one, the company has received $10,445. That's the initial assumption. And then it's a 5% coupon bond, which means every year the company is outflowing $500 in coupon payments. And then the last year, when the bond matures, $10,000 plus that final year's coupon is due at $10,500. So if we plug that into the IRR formula in Excel, we arrive at an implied interest rate or implied IRR. Another term for it is a discount rate of 4%. And again, had there been no original issue premium, it would just be the straight up 5% associated with the coupon. But because there is this premium, the interest rate is actually a little bit lower because the lender is providing a lot more value than they would have had they just provided $10,000. So the exact same story as in the original issue discount exercise with the coupon, except this time the amortization expense is negative. So we still reflect the coupon, the cash interest component, just like before, but we're going to calculate amortization just like we did before as 4% times the original loan balance. And if you minus the portion that's part of the coupon payment. So we're going to do the same thing that we did in the last exercise. We move that to the side and we see that based on the implied interest rate of 4%, the interest payment on an accrual basis is actually only $418 million. And so to get to that accrual-based interest expense, we need to subtract $82 million from the interest expense calculation. So let's make sure we do this correctly. We take revenues minus expenses minus the interest expense plus, which is minus the negative gives you plus that amortization. And so we have the right calculation. We fill that through across to the right. And we see that every year interest expense is less than $500 because of this negative amortization, which gets your pre-tax income to be higher than it would have been had there just been a $10,000 no original issue premium. Okay. You see, had this been 10,000, there'd be no original issue premium. But there is, so we recognize this. And now on the balance sheet side, what's happening is that every year the carrying value on the balance sheet of the loan is being reduced by the amortization instead of being increased like in original issue discount exercises until it gets down on the very last day to 10,000. So the last three exercises illustrate how original issue discounts and original issue premiums are accounted for on the financial statements.